Hi, welcome back to this series of videos on Ind AS, that is Ind AS with Accountsman. In the previous lecture, we had started with Ind AS 33, that is earnings per share, but we had not completed the same. Let's continue the same in this particular standard in this video. So in the previous video, I had told you that EPS basically has two forms, that is, one is basic EPS and the second one is diluted EPS, and we had started the discussion with regard to basic EPS. In basic EPS, I had told you that basic EPS found using this earnings attributable to ordinary shareholders divided by weighted average number of shares. And we were discussing the numerator computation, and in numerator computation we had done 2 points, and now the third point was pending, which we're going to start in today's lecture. So let's get started with preferential. Now, as Ind AS sees this, preferential is usually not an equity instrument. This can become an equity instrument. How? We need to read this in detail in financial instruments chapter, but I'll tell you the gist in here. So what happens with respect to preferential is, there is a determinable date on which we need to pay the redemption. We need to pay the dividend also, it's determined, and what is to be paid on redemption, how much is to be paid on redemption, and what is the dividend to be paid periodically is also determined. So as what do you say, dividend is determined and redemption is sure. There is no concept of irredeemable preferentials under Companies Act 2013. So as the dividend is determinable and redemption is for sure, this, though the name says it is share, it is actually no more a share. It is almost like a debt instrument. It is like a debenture. Only difference between debenture and preferential here is the name. Otherwise rest is the same. So we categorize this preferential as financial liability. Yeah. However, there have been certain circumstances where preferential can be categorized as equity instrument. That is when it is irredeemable and the dividend rate is not promised and not fixed. Yeah, such a kind of preferential is not in force in our country, but if it is there, it becomes equity instrument. So preferential, two things, can become equity instrument or can become financial liability. When will it become financial liability? It will become financial liability when a rate of dividend is fixed and it is redeemable. Preferential, then it will be treated as a financial liability. Otherwise, okay, if it is not financial liability, it will be termed as what? Equity instrument. What do you mean by EI? I'll write it so that you will not raise this question next time. What is it? It is equity instrument. I am not calling it as equity share. Equity instrument means equity share as well as preference shares. You get that? Which is irredeemable. But that irredeemable concept is not there in Companies Act 2013, so I am not writing that word. What I told is, equity instrument, preferential will become an equity instrument if it is not a financial liability, and I have given the definition of financial liability to you. This is as given under the standard. Yeah, let us get going. So if it is a financial liability, then what happens is, dividend is like interest. More importantly, it is charge against income. Whereas if it is equity instrument, dividend is appropriation of income. If I have to tell you in the terms that you will understand from your basics, if a preference share is considered as a financial liability, the dividend paid to this preference shareholder is like debenture interest paid. It will be taken in P&L account, and after deducting this dividend, what we get is profit attributable, and on that we did compute tax and everything. Whereas if this particular preference share is termed as equity instrument, then what happens? Then that amount of dividend paid to this preference shareholder will be regarded as appropriation of income, meaning after computation of net profit and tax and everything, then in your P&L appropriation, what we used to do under the traditional system, we write this there. You get that? Now, why am I telling this entire thing is because this, we know this, isn't it? We arrive at earnings before interest and tax, then we write less interest, then we write earnings before tax. From this we deduct tax, After this we arrive at earnings after tax. You get that? Then we write less, okay, I'll write dividend. I'll write dividend. Now, if preference share is financial liability, if the preference share is financial liability, then preference dividend on this particular instrument, yeah, preference dividend, ouch, yeah, I think it's not bad. Preference dividend on this particular instrument will appear in here at interest. However, if preference share is equity instrument, I am not calling it as equity share, it is equity instrument, then preference dividend would come here. I hope you got my point. You get that? Whereas after deducting this preference dividend, if any, whatever we get, this is ETOS that we are referring to, that is earnings available to ordinary shareholders, and this is our numerator. Numerator in computation of earnings per share. So irrespective whether the preference dividend is treated as interest or dividend, it will have no impact. We will always take it after charging this for the purpose of what? For the purpose of our EPS computation. But this tax here might get little adjusted. So that's an important point that we need to note with regard to preference share. But that's not the end. We have lot more to be discussed with regard to preference share. So I'll go ahead and then tell that to you. So let me take you to this place. Come on. A preference share can be cumulative or non-cumulative. Non-cumulative. What do you mean by cumulative and what do you mean by non-cumulative? Now, if a specific preference share is given as cumulative, such fact that it is cumulative should be given on the face of the share certificate. If it is not given, it is not to be considered as cumulative. Now, when a preference share is cumulative, what is the advantage? In the event of no sufficient profits or losses in a specific year, and if the company cannot declare any dividend to preference shareholders, such year in which no dividend is received by the preference shareholders will be noted, and in the subsequent year when the company makes sufficient profits, company will not just pay the dividend for that year, it will pay the dividend of the previous periods wherein the company could not pay dividend. So irrespective of the fact whether there is profit or loss, the dividend has to be paid. If there is profit, if they have cash, the dividend will be paid this year. If there is no profit, if there is no cash, the dividend payment will be postponed, but it is not cancelled. You get that? So cumulative means even in the event of loss, the dividend will be paid in the year of profit. It will be accumulated and then paid later. Non-cumulative, if there is no dividend declaration by the company, then there is no requirement to pay. Yes. How will this impact our EPS computation? No. If a preference share is cumulative, then irrespective whether you make profit or not, you have to pay the dividend. You get this? So don't wait, or okay, no point in declaration. No point in declaration. Dividend is deducted from what is a profit, okay, before computing EATOS. You get that? So to arrive at that profit which we use for computation of dividend EPS, we have to first deduct this preference share dividend. You get that? First to deduct this preference dividend and then only we'll go ahead. Why? No point in declaration. Here if it is non-cumulative, then deducted from profit only when declared. You get that? So we deduct that specific preference dividend from our profit before computation of EPS only when it is declared. If it is not declared, no deduction. Here no declaration, still deduction. You get that? Okay, if I have to tell in simple terms, deduction always. How about here? deduction only when declared. And with respect to cumulative, why are we doing this? Because irrespective of the fact whether it is declared or not, it must be paid, as it is a must. Must to pay. Later when it is paid, should we be deducting? No. When you basically at the end of the year, when you deduct this, it's like you have deducted from the profit, but you need to pay. If you don't pay, it will become a liability. Later when it is paid, it will become a liability settled and it will not be treated as expense anymore. You get that? So here the journal entry will be preference dividend to preference dividend payable. And later when it is paid, preference dividend payable to bank or cash. You get that? Okay. On payment, don't deduct from profit again, because you deducted when it is declared, don't deduct it, or you deducted in the computation once, don't do it again. You get that? That's the point with respect to preferential. Is this the end? No, we still need to note couple of points with regard to issue and redemption of preferential. Now let us see. Big point, as I told you yesterday, preference share, and I am talking about the first part, that is with regard to issue. And I have certain points to be discussed with regard to redemption as well. All this impact the profit. Yeah. So now what am I discussing? I'm talking issue of preferential. Consider this. Issue of preferential. Okay. Now with respect to issue of preferential, two interesting scenarios that I want to discuss. Yeah. Okay, the third scenario is of no use. Issued at fair value, like whatever the fair value of the share, that is the value that I am issuing, no problem. Issued below fair value, above fair value or market price. Yeah, so these two become very interesting cases. Below fair value and above fair value. Now, whenever the company goes for issue of preference shares below fair value, so it is basically company is issuing shares at discount. When I give a share of 10 at rupees 8 to you, you might be happy, but I am at loss. So, in order to compensate, what can company do? Okay, to compensate, company pays less dividend in the initial years. So 10 rupees share I paid it to you at 8 rupees. So I'll tell first 2 years I'll pay you only 6% preference dividend. After that I'll raise it to 8. I can do that. As a company I can do that. So I've reduced the rate of dividend because I've issued the shares to you at discount. Then the next point is the fair value or market value is there, but I've issued the shares at a higher price. You get what I'm trying to tell? So a share is of rupees 10, I've issued to you at 15 rupees. You paid me more. You'll say, you are not happy here. So I'll say, okay, don't worry. Usually I give preference dividend of 8% outsiders. I'll give you 10%. So to compensate, company pays higher dividend. You get that? So the interesting part here is company pays lesser dividend, company pays higher dividend. So that higher dividend or lower dividend rate, no, that is not the conclusive rate here. There is hidden adjustment with respect to the issue price here. You get that? So considering this entire thing by applying fair value measurement, we will arrive at something called as effective interest rate. Effective interest rates. This is IRR concept. Use the concept of IRR to arrive at effective interest rate. If there is computation of effective interest rate followed by the organization, we had discussed this little early also in one other standard. You get that? Maybe if I'm not wrong in employee benefits. Yeah. So we use that effective interest rate to arrive at some amount of interest rate. Such effective interest rate is on par with what? This is equal to dividend rate computed. You get that? So we revise the dividend rate. We say like, okay, no, that on the face 8%, 9% is not the actual dividend rate. That is what is played around with. Why? The issue price. So if I restate everything, I'll arrive at an effective interest rate. This effective interest rate is considered as dividend rate. This dividend is allowed. to be deducted in what to say profits, okay, from before computation of EPSL, right? Before computation of EATOS, that is earnings attributable to ordinary shareholders. So before we arrive at that, we need to here I told no, we need to deduct this dividend. So this dividend here or here, whatever we are deducting, it should not be the dividend rate that is given on the face of the preference share. It should be the dividend rate what is actually given, what is arrived at by applying this effective interest rate. You get this? Then so this with respect to issue. Now we're done with issue. Now we have to discuss redemption. So I'll take you to next page. The point is redemption of preferential. If there is any premium on redemption, previously under the old Companies Act, under the new Companies Act also, before the amendment came into picture, what we used to do was such premium on redemption of preference share was adjusted against security premium. Whereas under the new Companies Act, what we do is we cannot ever take premium on redemption of preference shares against security premium. What is it that we should do? We should take that premium on redemption of preference shares to P&L. If there is no sufficient balance in P&L, we cannot actually redeem the preference shares at what is say profit. So if there is any premium on redemption of preference shares, this amount is expense. It is expense. What is it? Expense to be deducted from profit. Yeah, before arriving at EATOS. Okay, EATOS. Before arriving at earnings attributable to ordinary shareholders. So before arriving at EATOS, in that profit, that income minus expenses, we need to include this expense also. What expense? Redemption of preference shares. Sir, here you spoke about two things and all. Why are you not talking about anything other than premium? I cannot talk about discount on redemption of preference shares because redemption of preference shares at discount is forbidden. We cannot redeem it at discount. Do you get that? So if there is any premium paid on redemption, such premium should be adjusted before arriving at EATOS. Next, we have to go to the last point. See this. So we discussed star number 3. Now I will take you to star number 4. Take you to the next slide only. In fact, this is the last one with regard to the numerator. Okay, let's get started. This is conversion. Okay, now what exactly are we going to discuss about conversion? Now, if there are any instruments like convertible debentures, those of you who know EPS little, you might say, sir, are you talking about diluted EPS? No, I haven't started discussion on diluted EPS yet. This is with regard to the premium. Yeah, I'll come back to diluted EPS little later. We have not gone so far yet. Yeah, so what we're discussing right now is convertible debentures, or if there are any convertible preference shares. This convertible debentures is supposed to be transferred to equity shares, or convertible preference shares which are supposed to be converted into equity shares or preference shares also. So as the case may be, if it is there, then there would have been pre-agreed fair value for conversion. That would be there. So I would have told, no, for every 10 debentures of yours, I will give you 1 equity share. For every 10 preference shares of yours, I'll give you 1 equity share. So I would have promised some pre-agreed fair value. That is number of shares. Assume that each share is of 10 preference share. For 10 shares, if I give 1, for 100 rupees value of preference share, I am giving 1 equity share. So it is pre-agreed fair value. Now, if this conversion is basically preponed, conversion before agreed date. Now I am supposed to convert your debentures or preference shares to equity instruments at the end of 5 years. Now at the end of 3 years only I want to convert. Now what I had promised was 5 years of you as debenture. Now I am doing it after 2 years. You might not be happy. So I will tell, okay boss, to keep you happy, I will give you more than what I had promised. Previously I told for 10 debentures I will give 1 share. Now I will give for 10 debentures 2 shares. So you are getting more than previously promised. So pre-agreed fair value is less, and then the current conversion rate is more. Current conversion rate is more. It is like 1 for 10. Now it is 2 for 10. This is just example. So if it is there of something of that sort, then if pre-agreed fair value is greater than conversion rate, such difference is premium. and it is expense. What is it? And it is expense. What do we do with this expense? To be reduced from profit to arrive at what? EATOS, earnings attributable to ordinary shareholders. So in the computation of earnings, which should be divided by weighted average number of shares for computing EPS, we have to deduct this premium payable on conversion. What is premium payable on conversion? Premium payable on conversion is the compensation for earlier conversion. You get that? So the key word here, what I am trying or asking you people to focus on is premium. What exactly is this premium? This is the higher conversion rate. What is it? What do you say? Higher conversion rate over the pre-agreed fair value. So by this, we are done with the entire discussion with respect to our numerator. So our numerator is completely done. Our numerator is completely done. Now what should I do? I should start discussing with respect to denominator. Come on, let us start discussing the denominator, that is weighted average number of shares, weighted average number of ordinary shares. Let me start discussion. This is our denominator. And in this regard, we need to see the entire thing from two important points. First one is time, second one is value. So let us start off with the first point, that is time. How exactly are we going to take into consideration time for weighted average? See, it might not be a case that the number of shares which is outstanding in the organization is same throughout the year. It can so happen that the beginning of the year there are certain number of shares. During there is certain issue happening. There is certain conversion of debentures into equity shares happening, or during there is bonus issue, or there is right issue, or the value of the share is changed, that is share split has happened. There is one share which is now broken into two shares, or it can also happen that share consolidation or reverse split. Every 4 shares is consolidated to call it one share now. Something of this sort has happened. So whenever this change is happening, which dates number of shares are we going to take? The first date or the last date? The answer is neither. We have to take the weighted average number of shares. So I am trying to tell you this one. So what you need to do is, you need to multiply the period for which it's outstanding, number of shares multiplied by the period for which it's outstanding, and the basis will be the time here. You get that? Okay, I'll tell you how do we find the weighted average number of shares. Number of shares multiplied by period for which such shares are outstanding. You get that? Divided by, let's say, such time period, or to say total time or year. If you take days here, you have to take days here also. If you take months here, you have to take months here also. I'll give a small example also. Now assume on 1st of April 2019, 10,000 shares are there, and on 30th of September 2019, additional 2,000 shares are issued. You get that? Then what do? I'll take it like this: 10,000 multiplied by these shares are there for entire 12 months. Now when 2,000 shares are issued, it is issued in September, October, November, December, January, February, March. It is there for 6 months. I'll do 6 by 12. Then it will become 10,000 here. Then this will become what? 2,000 into 1 by 12 becomes 1,000. And the total will be 11,000 will be what? Weighted average number of shares. Now imagine on 1st of January 2020, there is buyback of 1,000 shares. Okay, I'll not take 1,000. It will become awkward. I'll take 300. 300 shares, there is buyback. Then what will I do? I'll multiply with this by the period. What is the period for which it's there? It is there for, what to say, January, February, March, 3 months. I'll do 3 by 12. For 3 months it is not there. So what I would have to do here is subtraction. So 300 into 3 by 12, that is 4. So how much do we get? I'll do 75, but that will be minus. And if I do this 10,000 plus 1000 minus 75, that will become my weighted average number of shares. Okay, 9,000, how much is it? Okay, 10,000, sorry. 10,925. Yeah, correct me if I'm wrong. So this would become my, what to say, weighted average number of shares. So what is it that we do? What we do is we take number of shares, we multiply it by the period for which they are outstanding, and it will be divided by the year or the basis time. I can write it as basis time. If I took months here, I took months here. If I would have taken days here, I would have taken days here also. Here also months. You get that? That's how we arrive at it. But with respect to time, I am not done yet. I would have to discuss couple of small pointers. I'll tell you. So this is the extension of time now. Next up, we need to do a few things. Issue. If it is issue of shares, then date of issue is considered as a transaction date. Next one, if there is buyback, date of buyback is the transaction date. That day to year end is the period, and for this it will be minus, for this issue it will be plus. Done. Then comes the interesting one, bonus issue. Okay, I will not discuss this in isolation. I will tell you a couple of more things. Number one, next one, share split. Like one share, I broke it in half, it became 2 shares. Next one, share consolidation or reverse split. I had 2 shares, I bought them together, it became 1 share now, or it's also called as reverse split. Yeah, I do any of these. If I do any of this, then what happens? In these, there is no consideration or no cash flow. You get that? There is no change, in fact, basically, in resources. It is just that number of shares is changing within the entity. Then what do we do? Then what we do is date of transaction. Date of transaction is earliest available reporting date. Very important. Don't tell beginning of the year. A lot of them conclude this by saying what? Beginning of the year. It is earliest available reporting date. Like if I am preparing financial statements and I have a comparative for the previous year. So the previous year's earliest date is this. So this would not just affect the current year, but it would affect the previous year also. Previous year's denominator of number of shares also will change, and I have to recompute the basic EPS for my previous year. You understand what I am trying to tell? That is with respect to bonus issue, share split and share consideration. And the next one is right issue. Now how do we deal with right issue? Right issue is a kind of issue where the shares are issued, and no, shares are not issued. Now shares are issued, but before the shares are issued to public, the offer is made to existing shareholders to buy those shares. So I give them right to buy the share. I don't give them share. I give them right to buy the share. But whenever I am making right issue, we need to check right issue price is to be compared with fair value or market price. We need to compare it. If the right issue price is equal to fair value or market price, no problem. If the right issue is lesser than fair market value, then what's happening? Fair value or market price, the price at which shares are issued to outsiders, that price is more, but my right issue price is less. So I am giving shares to my existing shareholders at a little lesser price. Do you understand? So there is an element of bonus here. So with regard to right issue split, cash part, bonus part. Bonus part is they'll get it for free, meaning assume the fair market value is 30 but the right issue price is 20. Assume that you are buying 2 shares, you pay 40 rupees, you are supposed to pay 60 rupees. Supposed to pay 60 but you paid 40, so the 20 rupees what you didn't pay is bonus element. So technically if the share is of 20, you are getting 1 share as free. That's sort of a calculation. So for this cash, you go by date of issue. Date of issue. This is like earlier one only. Okay, if I have to route it through, it is like this. similar to this. However, if there is bonus element, then we need to treat this bonus part like this. You get this? Date of transaction. I'll write here. Okay, this is an important point here again. I'll box this up. Yeah. Ouch. Date of transaction. What is the date of transaction for computation of weighted average? It is earliest available date. I told this to you, but how do we compute it? Weighted average ordinary shares, or what do you say, the denominator. What am I talking about? I'm talking about denominator. Okay. How do we arrive at this denominator? This denominator is computed as number of shares, that is ordinary, multiplied by RF minus 1. Now there is an interesting discussion with regard to what exactly do we mean by this RF. RS means right adjustment factor or right factor. So what is this right factor? This right factor is computed like this. Here we have 30 and 20. If I do 30 by 20, this is my right factor. You get that? So this right factor is computed as what? Fair value divided by right issue price. Very important. Yeah, this right factor is fair value divided by right issue price. It will be more than 1, and if it is more than 1, only then it is what? It is there is that bonus element. If that bonus element is there, 1 is the consideration received. That extra part is the bonus element that we multiply by number of shares outstanding right now to arrive at weighted average number of shares, which will be used in our denominator. So all we did in this video is basically we started with redemption of preference shares. No, we started with preference shares. We discussed this entire preference share concept, and then I told you that when we talk about the denominator, we discuss about two things, time and value, and what I finished in this video is I finished the time concept. So the value concept is to be discussed. How do we treat with respect to value? So once we're done with the value, we'll put an end to this video and then discuss the diluted EPS in the next video. So what are we going to discuss now? We're done with time. So now I'm going to discuss the concept of value. Value. What do you mean by value? If there is more than one class of equity shares in the company, if there is more than one class of shares with different paid up value, there are certain shares. It is shares of rupees 5 each fully paid up. There are certain shares which are shares of rupees 10 each fully paid up. Now I cannot call all of them equal. So I don't have a common denominator. So what do? Those 5 rupees shares are there, 10 rupees shares are there. Can I say 2 5 rupees shares are equal to 1 10 rupees share? Or can I say 1 10 rupees share is equal to 2 5 rupees share? So I equate the number of shares and then arrive at the denominator. Then what do? Equated number of shares is computed. Equated number of shares is computed. So what is this? I'll show you an example. If there is 1000 shares of rupees 10, rupees 5 paid up, and 1000 shares of rupees 10 fully paid up. This is the question. So now what would be the equated number of shares for this? Number 1, it will be 1000 into, okay fine, I will not write multiply only, 1000. I am taking the base as 10 here. Okay, base as rupees 10. So then what will happen? This is 5 rupees paid up shares. So I will convert them. This 1000 into 5 by 10. So that becomes 500. and this 1000 will remain 1000. So I'll have 1500 shares of rupees 10 each. I have 1500 shares of rupees 10. This is one approach, or we can follow another approach, or what is the other approach? I will take base as rupees 5. So then this 1000 shares will remain like that only. Then what will I do? The next 1000 shares I will do 1000 into what is it, 10 by 5. That becomes how much? 2000. So then I'll have 3000 shares of rupees 5. 3000 into 5, 1500 into 10. Either ways it comes down to be same, isn't it? Yeah, 3000 into 5 and 1000 into 1500 into 10, it comes down to be same. So either of the bases can be followed. Either you can take the base as 5 or you can take the base as 10. Either ways of it is correct, and that will become our equated number of shares. And later you will find the appropriate, and then you reverse this. Now you done 5 by 10, later you do 10 by 5 to arrive at the EPS for that specific share. Yeah, that's how we do this. And by this we are done with the value part also. You get that? So when we're done with this, we're done with the denominator. I take you back here all the way. We're done with the denominator. I understand this video was little long, but I didn't want to keep anything other than diluted for the next one. So by this we're done with basic EPS. So if I take you back to the original one, I'll put a tick mark on basic EPS and tell that we're done with basic EPS. A couple of important discussions are still pending. Contingent, shares to be issued on contingency or anything, that we'll discuss towards the end. That is common for both basic and diluted. So in the next video, we'll discuss diluted EPS, and then few special cases like employee benefits shares, if it is there, how do we treat it? Shares issued for non-cash consideration, how do we deal it? Or if there is any contingency shares are supposed to be issued, how do we deal with that? Along with diluted EPS, the most favorite topic for all the students. So that will be seen in our part 3 video on Ind AS 33. So thanks for listening till now. See you all in the next one. Till then, stay in the game.